Today we are going to discuss about hammer candlestick. Why 90% of traders fail with the hammer candle. If you have ever bought a stock, the second you saw a hammer candlestick, only to watch the price dump immediately after, you are not alone. Most retail traders treat the hammer like a magic signal. They see a long wick, open a buy position, and get stepped out. Why? Because they treat the pattern in isolation, completely ignoring context, momentum, and structure. In this video, I'm going to break down the exact anatomy and psychology of a real hammer pattern, why color actually doesn't matter, and the specific market conditions that decide whether a hammer means a true reversal or just a trap. Now, anatomy. A valid hammer has three visual components: a small real body at the top of the price range, a longer lower wick, at least 2 to 3 times the length of the body, a little or no upper wick. Now, here is the question. Does the color of the hammer matter? A green hammer means the price closed slightly above the opening price, while a red hammer means closed slightly below. But the color of the body is not the important part. What really matters is long lower wick. It shows that sellers pushed the price down, that buyers stepped in and pushed it back up. So, to trade a hammer candle correctly, you need to understand what is happening inside the candle. When the candle opens, sellers take control and push the price down strongly. At this point, it may look like the market is going to continue falling. But as the price reaches lower levels, selling pressure start to weaken. At the same time, buyers may step in because they see those low prices as valuable. Buyers absorb the selling pressure and push the price back up toward the opening level. Now, the sellers who entered short near the lows are trapped, and that's what the long wicker is showing us. Sellers pushed the price down, but buyers fought back and took control. Now, this is where many beginners make their first mistake. They see a hammer and immediately think long lower wick, buyers are stepping in, let me buy. But trading does not work that simply. The same hammer can give you completely different results depending on where it forms on the chart. A hammer in the middle of the random range is not as meaningful as a hammer forming at strong support level. And a hammer after a weak, exhausted downtrend is different from a hammer that appears while sellers are still pushing the market down aggressively. So, instead of just asking, is this a hammer? Start asking, why did this hammer form here? Now, let's take a scenario: strong downward momentum. This is a trap example. Imagine a strong, aggressive downtrend with massive red candles and heavy selling volume. Suddenly, a hammer forms and the next candle closes slightly above its high. If you buy here, you are standing in front of a moving train. In a high momentum trend, those two candles are not a reversal. They are just a minor retracement or a brief pause. The dominant trend will quickly absorb those buyers and break lower. Now, exhaustion at support. You can consider it as a little real support. Now, compare that to a weak, slow downtrend where candles are getting smaller, or if you find any green candles in between the momentum or showing loss of momentum as the price approaches a key support level. If a hammer forms right at that support level, followed by a strong confirmation candle closing above the hammer's high, you have a high probability trade. Why? Because the trend was already exhausted and support gave buyers a logical floor to take control. Take control. Now, trend continuation. The hammer isn't just a reversal pattern. It's also an incredible continuation entry or continuation signal. When a market is establishing uptrend, making higher highs and higher lows, it will often pull back to retest the previous breakout, where old resistance becomes new support level. New support level. If a hammer forms right on that retest level, it confirms that the pullback is finished and buyers are stepping back into push for the next higher high. Trading a hammer with a prevailing trend is almost always safer than trying to catch a falling knife. Now, checklist. These are the checklists always you need to confirm before entering your trade. First one, location. Is the hammer forming at an important support level, demand area, or previous breakout retest level that you have to check? If it is forming randomly in middle of a range, its significance may be much lower. Next one is momentum. Look at the candles before the hammer. Is the selling pressure still aggressive or is it downtrend beginning to lose momentum? A hammer against powerful bearish momentum deserves much more caution. Number three, confirmation. Does the next candle closes above the hammer high? If yes, you have additional evidence that buyers are gaining control. So, always define your risk before entering. And finally, remember this: a hammer is not a buy signal itself. The real edge comes from combining pattern, location, context, confirmation, risk management. That's how you stop treating candlesticks as magical signals and start using them as information about the battle between buyers and sellers. If you found this breakdown useful, drop a like, subscribe to the channel, and let me know in the comments, do you trade hammer patterns based on real candle alone, or do you wait for context and confirmation? I'll see you in the next video. Thank you.